Hi, welcome everyone. My name is Srinivas Kunte. I'm the Director for Professional Learning and Advocacy for CFA Institute. Today's webinar is on valuing tech IPOs and also on understanding SPACs. We all know that technology is everywhere, from cars to finance, from healthcare to eating food. Technology has just penetrated everything. So although today's webinar is really on valuing tech IPOs, I'm sure the concepts and principles would be applicable for other IPOs that would be coming in on the hopper. And when it comes to valuation, it's the real heavy lifting, right? And for this, we've got a really star speaker, and I'm very grateful to Aviral Jain to come and speak on this forum. Many of you may have worked with Aviral. He's been volunteering a lot. He's the managing director for the valuation and advisory practice for Duff and Phelps. He's a veteran, of course, 15 plus years of experience in valuation, corporate finance, and restructuring mandates. I think his bio is half a page long, but just to cut it short, he's a regular, well-followed speaker in the media, prestigious media forums. He's a member of several government-backed committees, and he's got an impeccable academic background, MBA from FMS, undergraduate degree from Sri Ram College of Commerce, right? And in addition, he's got the ABB designation, and importantly, he's a esteemed and distinguished charter holder. So before we begin, some quick housekeeping instructions. Harshad would have sent you the mail. This webinar is there's a lot of material for Aviral to cover. I think there are 70 plus slides. He's going to touch upon different types of areas when it comes to valuing tech. He's also going to talk on soft skills, not just the valuation matrix. He's going to talk about trends, insights. But let me not, let me not steal the show. It's all his. I just wanted to inform you that we'll go slightly beyond the 1 hour usual tight time span that we have got. But having said that, please keep the questions coming. Keep the questions on the conceptual side of things, on why and how come instead of the what's. What we'll do is we'll try to answer as many questions as possible. Aviral wants to do it in a real interactive way. He's taken a lot of his personal time to put into this presentation, so I'm really looking forward to it. And when you ask the questions, just make sure that you put the questions on the chat box, in the Q&A box, not in the normal box where everybody sees everything. The Q&A box is where we'll pick the questions from. So without any further ado, it's over to you, Aviral. It's all yours.
Thanks, Srinivas, and good evening, everyone. I think it's great to be back, talking with the CFA community today. And the topic is obviously very interesting and close to my heart, valuing tech IPOs and SPACs. In fact, when Srinivas reached out to me a couple of months back and we were discussing topics, I think as soon as we discussed this one, it just, it was just a single yes, right? It's that sort of a topic. And before we take a deep dive, Srinivas has already cited you stating the number of slides I have in the deck, which I didn't want to, but now that it's out, I thought I'll add a few of the disclaimers and caveats as a corporate finance or a valuation professional. So this document is being prepared for limited educational purposes only. The views and opinions are strictly personal and subjective. It should not be construed as investment advice. We have sourced case studies from public domain. We have picked up information from public domain. We have a lot of examples and pictures, and all the IP belong to their respective owners, which have been properly referenced. We have also relied on a lot of third-party data, which has come from reliable sources of databases, and however, we can't take any responsibility. With this sort of a disclaimer, let me straight away jump into today's broad agenda. We have 5 sections to cover, starting with the basic trends on IPOs and SPACs, what's happening around us. Moving on to analyzing the tech index and the recent tech IPOs. With that, we'll jump into results from a study which we have carried out in-house from tech IPOs, almost 90 IPOs getting covered in that study. From there, we'll move on to the discussion on valuation matrix for new age businesses, for digital businesses, covering three important pillars of unit economics, market potential, and relative analysis. And finally, just giving you glimpses of typical disclosures, which may be critical, and also being wary of the storytelling. So that's a broad highlight. I think, as Srinivas mentioned, feel free to ask questions, I think, through the chat box. And I think Srinivas is the gatekeeper. We've discussed, we'll try and pick up Q&A. And if you're really falling behind, then maybe we can pick it at the end. So with this, I'll jump into the section 1, which is on IPO trends on emergence of SPACs. If you see the slide, I think it shows the number of IPOs and the proceeds which have been raised over time. No wonder towards the end of it, if you look at 2020 and 2021, we have tall bars. The number of IPOs have been amongst the largest in the recent history, the last 10 years. And even the funds raised, I think have crossed $100 billion already in year to date. If we were to look at from a sector perspective, the TMT and healthcare is pretty much the leader. Together they're about 50% on the funds raised. And again, actually more than 60% on the number of IPOs. Some of the other sectors which have seen good activity includes financial sectors, industrial sectors, materials, etc. But largely it's driven by tech and healthcare. And some of the largest IPOs in the recent past are here, and I'm sure you can see some of the familiar names here: Didi Global, Coupang, Snowflake, Airbnb, DoorDash. All of them have come in the top 10 US IPOs category, on an average raising $3 to $4 billion. Now let's also look at the other category, which is SPACs. I think we keep talking about SPACs, and just for the benefit of some of you, SPACs are special purpose acquisition companies. It's not something new. It's always been there. I mean, we have already had a SPAC structure. It's just that in the recent years, SPACs have gained immense sort of importance because of the sheer numbers. In fact, 2020 became the first year when we had more SPACs than IPOs, almost 248 SPACs rather than 200 change IPOs. And if you look at the number for 2021, it's more than 400. And with this growing strength and expansion, even SEC has come up with detailed guidelines, and we'll talk about it later. They're also worried with the kind of I would not say a bubble, but with the kind of activity and the level of activity which is happening, it's definitely attracting a lot of eyeballs. Now, if you notice on the sector front, it's pretty much very similar to IPOs, the TMT and the healthcare, again, around 50%, followed by consumer and industrials. If you notice from a quantum perspective, I think we have had almost $155 billion of de-SPAC transactions which have got announced, which is mind-boggling. This I'm talking about is one quarter, the latest quarter which ended. We've had 39 completed de-SPAC transactions of $81 billion, and we have 410 active SPACs looking for targets. Basically, these are the vehicles which are listed, which have raised funds, and are now looking for active M&A targets in the overall space. From the top 10 SPAC perspective, I think the largest deal just got announced a few months back, the Grab, $40 billion deal happening on the Grab. This is the competitor of Uber in the Southeast Asia and other markets. And then we have some of the other players, MSP Recovery, Aurora Innovation, about $11 billion, UWM Holdings, Blue Owl Capital, and so on and so forth. So fairly large amount of activity happening, big numbers, big deals happening. Now, what is driving all these trends, right? So the first and the foremost trend which comes to my mind, and which is really everyone is aware, is the low interest. Since COVID, We have had almost 0% interest across the board. The Feds have continued with the 25 basis point sort of a rate. We recently, few days back, had a Fed meeting, and what I'm seeing every time they have a meeting, they keep pushing the timelines for tapering down the liquidity to the next year. Though it's come down. I think earlier last year we were talking about 23, 24. Now we are talking about 22. But still, the interest rates haven't changed. You look at Europe. Europe is almost sub-zero there. In fact, you get more. In fact, you got to pay if you want to put money in the bank. That's what I hear from my friends back in Europe. So with all these activities happening, what's happened is that the cost of capital has come down simply because it's like we are in an era of free money. There's no interest rates to pay, right? And accordingly, the return requirements have come down. The other important parameter, what's happened with COVID is the savings have gone up. Now, at one given juncture, you have lower interest rates. At the other given juncture, your consumptions have gone down and your savings have gone up. And more importantly, there is exceptional level of liquidity in the system, just exceptional. You look at the US money supply, you look at the Europe money supply, it's the highest. I mean, pick up last 20 years, it's the highest. In fact, it's said that almost 40% of US dollars in existence have been printed in the last 12 months alone. That is the kind of liquidity which has come in. Now, all this excess money is sitting to get deployed. In fact, it is said about $3 trillion of US money is still sitting on sidelines to be deployed in assets. And no wonder, you look at any asset category, you pick up commodities, it's going higher and higher. You look at cryptocurrency, currencies with notional value growing higher and higher. And of course, our stock markets, they are also at all-time highs. And who's to be blamed here? There is no interest rates or zero interest rates. There is less consumption, more savings, and finally, the governments have pumped in excess liquidity, and this is thanks to COVID, I would say, because you need that sort of liquidity in the system to sustain. So all these trends put together has created a kind of a I would say a momentum, which is never to be seen earlier. Moving on, the next section is on analyzing these returns. And if you step back and think about some of the data points which I have shown, the tech sector had been one of the most promising sectors, whether you look at IPOs and SPACs, the number of IPOs and SPACs, or the funding raised by these sectors. Accordingly, we have taken a little bit of deep dive into how the tech index has performed. So if you see, this chart shows the 5-year return on the tech index. The top two lines, which are there, represent Dow Jones US tech sector and the S&P North American tech sector. These are the ones. And the bottom one is S&P 500, which indicates a broader market. All these have been indexed to 100, and then total 5-year return index has been presented here. So if you notice, since COVID, the gap between the two indices or the broader market index and the tech index have really widened. Almost from a return perspective, we are looking at 1.5 times the return at an overall level. And if you were to look at from an annual return perspective, we are actually looking at about 30% annual returns for the tech sector. This is last 5 years return. You pick up S&P, you pick up Dow Jones, you pick up NASDAQ 100. However, if you pick up some of the other indices of S&P 500, the industrial index or the healthcare index of financials, those are pretty much there where it should be, about 15%, 16%, because that's what still higher than what you expect in the US, but pretty much something which we have also seen in the recent past. Now, what is driving all this? We are looking at stellar returns in tech across the board, and it's not a 1-year thing, it's a 5-year sort of an index. So one concept I'm sure which you have heard of is FANG. I'm sure you can guess it easily. FANG, F for Facebook, A for Amazon, A for Apple, N for Netflix, and G for Google. Now, these companies, they together have a combined market cap of $7 trillion. Now, the companies with such huge market cap have actually grown in almost 3 digits in the last year and a half. You look at Facebook, 82% return, Amazon, 83%, Apple, 100%, Netflix, 76, Google, 112. So together, and if you look at from an annualized perspective, they've actually grown at 45%, beaten even the tech index, which we are seeing of 30%. And what is driving all that sort of a returns, that crazy money following the FANG? I think one clear reason is that they are the market leaders. So people know that the probability of default or the probability of losses are much lower, and they can easily beat up the competition. Now, if you look at and so this is about the story from the existing ones. The market leaders are probably becoming bigger and bigger and bigger, and we have had the top two, the top three always doing very well. From an overall IPO perspective, if you see,
sorry, just one quick sorry to, so the flow is extremely nice, and I'm really sorry to interrupt the flow, Aviral. One quick thing, on a perspective on SPACs, Sean Young had this question on, if there is any historical cyclicality, and I was reading an article on FT. So can you give some perspective on when did SPAC start? What do you think? Question number one is, on the history of SPAC. The second is, on what is changing right now. Is it totally different in terms of liquidity? Japan had its liquidity era from 1989 and 1991, and we've seen liquidity, several liquidity eras later on. Is it different this time?
Right. So, Srinivas, I think SPACs, as I said, has always been around. And there was a slide on number of SPACs in the past versus now. I think the difference really in the previous era and today's era is the era of a free money where the interest rates are almost zero, and B, very, very high liquidity. Now, when you have such surplus money sitting to be deployed, it's going in all asset classes. It's going in across the board. You have, as I said, commodities, you had cryptos, you have stocks, and then you have tech stocks, which are supposedly very risky investment. Now, from a SPACs perspective, if you notice, why have SPACs really emerged during these times? Now, the first and the foremost is faster timelines, because if you were to deploy that capital in capital markets, a traditional IPO takes 12 to 18 months. Now, given the COVID scenario, given the changing scenario, no one is sure, when will this liquidity cycle end? When will the fiscal stimulus, which is being infused by the governments, end? Maybe another 6 months, maybe another 9 months, 12 months. We were hoping there'll be a wave in India as we are talking, but there isn't a wave because our vaccination program has done better. So there are these uncertain trends, pluses, minuses. So what really happens when you think about deploying capital in an IPO, it's a long planning. It's a 12, 15 month sort of planning. However, with SPACs, looking at 4 to 6 months, you're looking at getting the vehicle listed, you're getting the right team, right sponsors, experienced sponsors who can find the right company, and then acquiring the company, doing a reverse merger with an existing company which has a good business model, and getting it listed. And the other advantage is that some of the investors can actually invest before the acquisition takes place. So SPAC gets listed, the vehicle gets listed, you can pull in retail money with your story that you're targeting businesses in consumer sector, in digital business, in financial services, in developed economies, developing economies, etc. So even before you acquire a target, you've actually started collecting capital. So and plus there's obviously a redemption option if you fail to deliver. So if you combine all that, it's a much faster, quicker route of raising capital, and I think the market has really timed it very well, I would say, in the sense of catching on these macro trends and monetizing them.
Right. So let's come back later on, because there's a lot to cover. I have a question on SPACs and their credibility, but let's come back to that later on. Thanks a lot.
Sure, Srivas, thanks. So continuing, I think we talked about the FANG movement which we had. This is the slide on which we have top tech US IPOs in the last 3 years. We have filtered IPOs based on minimum billion dollar size and presented some of the top ones. And if you go through the list, I think it's pretty much very well known, large digital businesses, companies, some of the software companies, etc. We have Uber, Coupang, Didi, Airbnb, DoorDash, Snowflake, etc. One interesting statistics I think which I notice is that the average and the median market caps of these companies are close to $30 billion, 30 to $35 billion. That's fairly large, and they got traded at about 20 to 25 times revenue. That's the time when they were traded, they got listed. That's the day one of the trading. And a year forward or 2 years forward or 3 years forward, depending on when they got listed, they're still trading at 20 to 28 times. So the multiples have really not fallen from that perspective. Let me take a slightly more deeper dive on what happened to the share prices of these companies. So if you notice, we have had almost like a median sort of a run of 20% return. This is, if you notice, most of these listings are in 21 and 20. So maybe on an average, we have had less than a year sort of a return. And on an average perspective, we have had 50%. The stellar performer was Pinterest, and which gained almost 200%. And possibly the reason could be the revenues have doubled and they become profitable from negative 119% EBITDA to 12% EBITDA. Now, another data point which I saw, which was a little on the downside, was Didi Global, which had a brilliant listing. We just looked at the stats of $4.5 billion of fundraise. The share price fell by 34%. Now, one thing you may have noticed, and maybe you've already seen some of the articles, what's happening is there's a great Chinese crackdown happening. And that's impacting a lot of Chinese stocks listed in the US and more importantly, listed in China. So if you notice, stocks like Alibaba, stocks like Tencent, Meituan, Didi, all of them are following. In fact, if you just add up the market cap they've lost in this great Chinese crackdown, it's about $1.5 trillion in less than a year. Alibaba and Tencent themselves have lost 700. And Didi got caught in this because the Chinese government initiated cybersecurity reviews and said that, please wait, don't register new users, let me review what you already have. Clearly, I think China is in a mode where they're fearing the size of these tech giants which have come in, and they want to control. They want to control the companies, they want to control the data, they want to possibly, I should not use the word overtake, but possibly in some manners overtake, or break them down in different pieces so that they are manageable. And this is all being done under the garb of that there is a growing divide between rich and poor. They want stability of power in the middle class. They have certain strategic industries in mind which they want to control. Though data points do indicate, yes, China, there is a growing disparity. If you see on the chart on the left, the billionaire wealth have almost become 10x in the last 10 years. So whatever happens in China, I think there are certain beneficiaries, and I'm sure sitting in India, there is a positive sort of an impact where some of these global money, the hot money, is now relooking at the China strategy and positively looking at India. Now, we should also look at some of the SPAC transactions. What were the top tech de-SPAC transactions? When I say de-SPAC, basically I'm talking about a reverse merger. So one is a SPAC listing, but when the SPAC merges with an unlisted private company and does a reverse merger, it's called a de-SPAC transaction. So some of the top de-SPAC transactions include, one of these is Aurora Innovation. It's a California-based self-driving software company. Then we have Circle Internet Financial. It operates a cryptocurrency platform and an emerging a sort of platform for internet businesses for all kinds of payment with a unified platform, and so on and so forth. If we look at the revenue multiples, These are not very different from the IPO multiples, but slightly higher, I would say, than the IPO multiples. We are also touching 30s and 40s versus the standard market. And if you look at the trading multiples, I think the data is possibly a little misleading because some of the SPACs are waiting to be listed. The D-SPAC, while the transaction has been announced, it's still awaiting SEC approval for the listing to happen. So the multiples are not capturing all the data sets. So maybe we can avoid looking at these averages and medians on the trading side. And in this presentation, what I'm going to do is I'm going to pick up both Aurora and Circle as some of the case studies in the coming sections. With Aurora, since we have mentioned Aurora, let me just talk briefly about what does it do. Aurora develops software and hardware products for self-driving vehicles. It's based in California. And the transaction which I just mentioned, they entered into an agreement to be acquired by, or to acquire rather, it's a reverse merger, a company called Reinvent Technology Partners, which was a listed SPAC vehicle, in a reverse merger transaction of $10.6 billion. The transaction is awaiting closure. It had revenues of $19.6 million in calendar year 19, none revenues, zero revenues in calendar year 20. In the funding rounds, it has had few funding rounds before. In 19, we have had companies like Amazon investing it at $1.7 billion. Uber also came in December 20. And finally, we had a SPAC transaction, de-SPAC transaction where Volvo also got involved. The below chart indicates how the valuation of this company has moved. From a seed round, which happened a few years back, it was 500 million. It had a Series A at 3.7 billion. Then Series B at 1.7 billion. This is all pre-COVID. And then came venture debt of 400 million. And then finally, we are looking at a SPAC value of $11 billion. 4x, 5x, I don't know how many x's growth we are seeing in the last 2 years. But that is, and the story is not extraordinary. I'll be honest, you pick up out of the list, which I had shown previously, 4 out of 5 companies will have a similar story, where they've just got founded, they're doing some R&D development, they have a fantastic product, fantastic storyline, revenues have started coming in, but really small, but growing very fast. And they have some of the biggest backers prior to the SPAC transaction, and then it's got a SPAC transaction done. So what's leading to all these returns in the tech sector? In order to find out, let's jump into the study which I just mentioned when I started this session, which is on decoding returns from the tech IPOs. In this study, we've picked up companies which have had IPOs in the last 5 years on major US stock exchanges. The filtration has been done on the basis of market cap, at least $1 billion market cap as on the date of trading. And we got about 90 companies in the study. Some of the companies considered in the study includes, let's say for 2020, the top 3 are Airbnb, Snowflake, DoorDash. In 19, we have Zoom, we have Uber, CrowdStrike. Then we have Dell, Spotify, we have Snapchat, and we also have Twilio and Trade Desk, etc. What we've done is we've collected data for the last several years since listing. So especially in this 5 years, so we have collected data of at least 6 years, 7 years. And then we have plotted the returns coming from the stock. So let's look at what is the kind of returns we have had. So in terms of stock returns, now let me first explain you how to read these tables before we jump into the outcomes. The first column is on the year in which the companies got listed. This is the count. These are the number of companies which got listed in individual years. This is the year which is linked to the IPO years. So for example, in this case, IPO year plus 1 for 16 will be 17. So this is 2017, 18, 19, 20, 21, right? Similarly, for 17, the 21 ends in year 4. This is all year to date. For 18, it ends in year 3. For 19, it ends in year 2. And for 20, it ends in year 1, because that is the kind of run they have had since listing. These are the CAGRs. Now, there are a lot of NAs. These NAs are basically for the years which are yet to be seen. So for example, 17 plus 5 will be 2022. So that's why it's an NA, and so on and so forth. So if you were to look at these data points, the last cells in each of these data points and each of these tables will be the 2021 returns. For example, here we are presenting average market cap return. So these will be the average market cap returns for this data set. 16 had 50% average market returns in 21 year to date. 17 data set had 78%. Like that, we can interpret. The second table on the right is everything else is the same, just that it's median. The reason why I've done average and median, because we have had cases in this data set where one company had 10x growth, right? One company had 5x returns, so sometimes averages get skewed. So I thought it's good to present media. Finally, we also have a little bit of color shading here. The darker colors in this case indicate higher returns, whereas the lighter colors indicate, standard returns or closer to market returns, and possibly no color, let's say in this case, is close to very market return. That's how the color index is working. So if we see, generally speaking, we see darker color shades towards the end of 2021. This is 2020, right? And lighter colors before that. So clearly the last 2 years, the tax returns have been phenomenal. You're looking at 50%, 60%, 70% return. Remember, I'm talking about companies which are about more than $1 billion market cap. So most of these companies could be in top 2, top 3, top 4 of their market segments. Let's also look at what are the stock multiples. Now, average stock return multiple is basically if the stock prices were $100 at the time of IPO, what is the stock price today? So for companies in 16, for example, if they were listed at $100 in year at the IPO year, which is 16, today they are 7.5 times. So the average stock price is $750, right? Similarly, for 17, it's 4.2 times. For 18, it's 2 times. For 19, it's 3 times. In just a matter of 2 years, not even for 2 years, we're looking at a 3x return in those stocks. And for 20, we are looking at 1.5 times. Clearly, the stocks have really zoomed. No matter if you recall the indexes, they were really beating the broader market index. We were looking at a 30% CAGR there, but that was a broader market. This is a smaller data set, right? We look at the FANG movement, right? This is not exactly the FANG movement, but closer to that, not very far away from that. And couple of interesting names. We looked at Pinterest, which had a decent run in the recent past. Its market cap has jumped 4 times, from 12 billion to 48 billion since its listing in April 19. And that's why we have 3x here. Suddenly 7.5, 4.2, 2.1, but 3x here. So maybe it's driven by Pinterest here. And in 17, we had a company called Snap, which again has grown by almost 4 times in this period. Now, with these sort of returns, I think the first and the foremost question which comes to my mind is, how have the revenues performed? Have these companies actually grown or not? And how do we look at? So let's look at the revenue growth heat map. We have had a stock return. Now it's a revenue growth. Now, very similar to the stock return, exactly the same heat map. It's just that if you notice the green shaded portions, which indicates higher growth of returns, are mostly around, even if you look at the average set or the median set, are mostly around at the IPO years. So immediately prior to the IPO or the IPO year, the returns were the max in terms of revenue returns. And over time, I think these returns are more stabilizing. The revenue growth rates are more stabilizing. But the overall revenue CAGR seems to be still in a healthy shape, overall 30 to 40%, if we notice. And if we apply the same benchmark on the multiple, when we looked at average stock return multiple, this is the average revenue growth multiple. So basically here I'm saying is, if we start with $100 of revenue, what is the revenue today? So mostly we are seeing about 2 to 3 times. I mean, if you look at across the data set, you look at average or median, the revenues have become 2 to 3x, whereas the stock returns, I think, were 4x, 5x, 6x, etc. Right? Now, if we were to compare these two data sets now, we have had stock returns, right? We have also had a revenue sort of a growth. If we were to compare these two, it would give us a ratio of whether the stocks have actually overgrown the revenue growth. So if we plot the two multiples, A divided by B, stock return divided by revenue growth returns, these are the kind of multiples which we'll see here. So 1x multiple here indicates that the stock returns are actually in line with the revenue growth multiples or revenue growth returns. And if we move towards the right side where we have yellowish, right? There's a cell which says 2x here and 2.1x here. It indicates the stock returns are actually more than double the revenue growth returns. Now, perhaps the multiples have got overheated, right? Because in the recent past, I mean, if you look at the years after the IPO, year 1 or 2 or 3, they're pretty much in a range, right? Across the board, you look at average or median, they're pretty much in the range 0.8, 0.9, 1, 1.1, 1.2. But suddenly, if you look at last year, let's say 2021, the last quadrant of each of them, we are looking at 2x, 1.5x, 1.1x, 1.4x, and 1.2x. So perhaps either the markets have got overheated or there is an expectation that the revenue growth will beat the stock returns in the near future, or it could be a combination of both. Now, this trend can also get highlighted from an EV by revenue perspective, because if stock returns are more, our enterprise value will be more. Our revenues haven't grown pretty much in not that much in line with the stock returns. So what's going to happen? There's going to be an expansion in the EV by revenue multiple, and that's what we see. So initial years we were looking at 8x, 10x. I think if you look at the large zones, 2016, 17, 18, we were looking at 8 to 10x pretty much across the board. However, as we move towards 19 and especially 20 and 21, multiples have suddenly become 20x. You're looking at 18x, 20x, 22x, etc., etc. That's the kind of sort of multiple jump which we have. And in valuation parlance, as soon as we have that sort of a jump, what do? Immediately we say, let's look at margins, right? Because if the margins have jumped, perhaps it justifies the gains in the revenue multiples. So let's look at now the EBITDA margins. This is the profitability heat map. Now, in this one, the higher the percentages, the better it is. But if you notice, we haven't had any of these companies, any of these data set making a positive margin except one or two cells where I see 0.9%, or there was one 8.8%. Maybe there is some, there were some good years somewhere, but across the board, we are having a negative data set. All the companies continue to be loss making across the board. However, a silver lining is that the percentages have come down. So you're looking at 10%, 20% at the time of IPOs, that's actually come down to 4%, 6%, and 2%, 3%. The recently listed ones, however, haven't come down, and obviously there could be reasons around it. The other factor, I think, since these margins really are not giving us the picture, it's improved, but really, really not indicate why should the revenue multiple or the EV multiple rather be higher, is the cash flows, the free cash flows. So what we have also done is we plugged in the free cash flows here. The free cash flows as a percentage to revenue. Now here there is some story emerging. We have negative cash flows becoming positive cash flows. We have small positive cash flows becoming big positive cash flows. In fact, some of the darkest cells are towards the year end of 2021. Isn't this amazing? When I looked at first data, I just jumped out of my seat. I was like, what's happening? It's going beyond my understanding. The margins are negative across the board, 5%, 10%, 15% negative. And the free cash flows to the firm are positive. We're looking at 15%, 18%, 12% sort of free cash flow. And perhaps the market is right. There is something wrong. Maybe if you're benchmarking only with EBITDA, maybe we should start benchmarking with the free cash flows, and automatically the stories will change. As soon as I was thinking about that, then I just made me realize that EBITDA is supposed to be the purest form of a cash flow, right? That's what we are taught all about. Whenever we do our corporate finance courses or CFA, That's what the course teaches us. It's the purest form of cash flow. So why is there a big gap? So then I started thinking, maybe let me come down. So when you have a P&L, you come down revenue, expenses, EBITDA, interest payments, tax payments, depreciation, which is non-cash, so it's added back. And then you have something called capex, you have something called net working capital, right? And then you have a cash flow. So taxes, I don't think it's gonna have such a big impact that your EBITDA margin and FCF will change. If they'll remain consistent across the board, interest payments and depreciation as well. So one thing which came to my mind is net working capital. So let's look at how net working capital now has changed over a period. Now, this is the graph which presents the net working capital as a percentage of revenue. Interestingly, all the companies continue to operate on negative working capital. And that's true for, I think, almost all the tech models. You take in cash first and then you make the payments at the month end, or you even take 60 days credit, etc., from your vendors and suppliers, etc. And is there a trend emerging? I started looking at the colored circles or colored cells. I couldn't really get a proper trend because it's pretty much across the board. Even at the IPO year -1, they were doing negative working capital. IPO year, maybe it came down slightly. And maybe in IPO year -1, they did not have too many funds. So maybe the current liabilities were building up. Then over time, I think it's pretty much across the board. So it really doesn't indicate, or it doesn't really fill the gap, which is there between EBITDA and free cash flows. So what should be the gap? Then we looked at more detailed P&Ls and came one item, SBC. Any guesses what is SBC? I know it's a virtual mode, so let me only answer for myself. It's stock-based compensation. Stock-based compensation as a percentage of revenue for these companies have increased from 4%, 5% to 15% to 20% of revenues. And this is a non-cash item. This is amazing how the stock-based compensation has increased. So if you look at for these tech companies, overall, they were all in the range of 2%, 3%, 4%, single digits, mid-single digits. Closer to 2020 and 2021, suddenly you see these crossing into teens. And lately, we are also seeing some of the companies started paying in 20%, 25%. So what are we saying? We are saying that 20% of our compensation as a percentage of revenue is being paid in stock rather than cash. And that is why, while EBITDA is negative, our free cash flow continued to be positive. Now, is this something sustainable? Is this something real? Because what happens when all this compensation is paid in cash, right? So as soon as we have such a large component of compensation being paid in cash, everything gets wiped out because your free cash flows, if you recall from the previous slide, or let me try and go to the previous slide, it's exactly in this range of stock-based compensation, 15%, 17%, 18%. So the day the stock markets start behaving irrationally and the key employees start demanding compensation in form of cash and not stocks, things may have a U-turn. So that's a broad sort of an analysis, and with this sort of an analysis, we thought maybe now it's important to jump into what should be the valuation matrix for these new age companies, which is my next section. Before I jump into this next section, Srinivas, just doing a quick check. Is there any question you want me to answer, or given the timelines, you want me to continue?
So there is lots of questions actually. I mean, one of them is on SPACs and their relevance to India. That is Arvind Mathur has asked that question. There's another on basic definitions from Athapon, but I think Arvind answered those questions for Athapon. There's one more on, can you elaborate on? Anand is asking on SBCs. Just keep those questions in your mind. I'm not necessarily saying that you can answer them. You should answer them now because I know there's a lot to come. And I'm sorry, all of you. Thank you for the questions, but I'm sure you'll be interested more in listening to Aviral on what he has to say, and that is that is to come. Shardul is asking, and there's one more question from Sankalp as well. How do we factor in factors, that I know you're going to cover that later on. How do you factor in factors like, China's actions, recent Chinese actions? How do you factor actions like Aurora and, the risk with auto driving cars? That is one from Sankalp. So this is just to give you a feel of questions, Aviral. I would rather,
Thanks.
move on right now.
Yes, Srinivas. Thanks. And these are all very critical and pertinent questions. And what we'll try and do is try and answer a few of these as Srinivas, I'm talking, especially for the queries which can be answered with the content which is there. Otherwise, we'll pick it towards the end. So with this, let me jump into the valuation matrix for new age companies and digital businesses. See, there are different parameters, there are different methodologies, there are different. I mean, you'll pick up the books, you pick up the courses, etc. You'll find a lot of things. I just picked up three important parameters, which I personally found very important. One is understanding the unit economics, understanding the business model, and what is the unit economics. Number two is the market potential. What is the market we are talking about? What is the TAM? What is the shares, etc. And number three, how does it stand vis-a-vis the industry? So let me start with the first one, which is unit economics. I'm sure most of you are already aware, but just as a recap, we used to have something called gross metrics earlier, where we used to, when this whole e-commerce started in India, all the companies were looking at gross matrices. You had website traffic, you had visitors, you had users, you had GMV, which is the most commonly used term, how much dollar sales. In fact, even today, I see some of the valuation notes coming for these early stage companies which are trying for listing now. They're still benchmarking themselves EV by GMV. They're still doing that. And then finally, what is the revenue coming out of it? But for the new age companies, I think what's important is to look at unit economics. And the reason why it's also important is because your gross metrics might continue increasing every year, but still you will have no idea whether when will you make profits. And that's why it's important to understand what is the kind of profits you can have at a unit level. Now, in order to understand the unit metrics, you need to look at your customer acquisition cost. At what cost are able to convince a customer to buy a product or a service? What is the retention rate? Or in effect, what is the attrition rate? How many customers actually survive by the end of the tenure? What is the lifetime value from these customers? Because eventually what you need to look at is you've already made an investment in a customer by making an acquisition cost. There is a risk we may lose customer. So what is my lifetime value? How much attrition adjusted revenue can I make from this customer base? And finally, what is the contribution margin? Contribution margin is a comparison of the attrition adjusted revenue which you make vis-a-vis the cost. Uh, as I said, the gross metrics is a problem because now what I've done is I've just presented briefly what is the GMV of Amazon and Flipkart over the last 6 years or so, 16, 18, and 20. If you notice, GMVs have continued to increase, 2 to 3 billion to 7 to 8 billions to 11 to 15 billion. At the same time, revenues have also increased, which is good, from 0.3 billion to 1.5 billion. However, these two bottom lines, if you see right at the bottom, these are losses. The losses haven't really shown a trend, and which is quite disturbing to me as a corporate finance analyst that, you know, ideally with scale, the losses should actually move into profit zone or at least have a trend, but it doesn't appear so. So that means they're continuing to burn somewhere down the line. And that's where it's important to understand the unit economics. And it goes to the basic, the chart is, if you remember your micro and those days, you'll remember this chart that there is plotting of total revenue, there is plotting of total cost, variable cost, and fixed cost, and really looking at the break-even point. However, the only difference is we are doing at a unit level, which is the customer level or a user level, rather than just purely at the company level. That's the difference. And why is it important? It's important because you need to understand at what scale will you actually achieve profitability. One is that at a unit level, what is the profitability? The other is when you scale it up and pass all the fixed costs, then what is the break-even point at which you really need it? So you can plot in certain variabilities as well. And as the curves change, you will also understand really, is this business model viable or not? For example, you have a blue line, here, if a blue line sort of a revenue line is there, maybe it's going to take some more years. But if it's a red line, very close to your variable cost, I don't know when it will really make numbers. So let's look at from a case study perspective. What I did was I picked up a case study of Zomato because it's got recently listed, and there's a lot of data available in public domain. The DRHP is very, very informative, and I really liked it the way they presented all the statistics. So I was able to recreate the unit economics, at least to some extent here. This is just a model. I don't need to, I think, get into details here. Everyone understands how Zomatos make money. Customer pays Zomato pays a share to the restaurant and a share to delivery partners for their delivery services. They also make some of these collections, which is on delivery charges, packing, tips, etc., is passed through. So it doesn't come to Zomato. But some of these are not exactly passed through. And we will see which ones are not passed through. So if you notice, this is a table again coming from DRHP or Zomato. This is for 2020 unit economics, where this is the kind of commission they made. This is the delivery charge they recovered. This is the total delivery cost, which is commission. This is the total delivery cost on actual delivery cost, because recovery is much lower than the actual cost. Finally, they have given some discounts and there are other costs, and this is the contribution. It was negative. Right. However, if we were to run the same stats for 2021, this became positive. And this was the first year, per se, when the contribution became positive. And what drove these contribution positive? So if you notice, the first bar is much larger, 43 rupees becoming 63 rupees per order, which is driven from what? It is actually driven from AOV, which is average order value, which is about 400 bucks, much higher than 300 bucks. So if you get 20% of it, it's definitely going to be higher. The second one, which has changed, is the delivery cost. They're recovering much more from the customer, 27 bucks instead of 15, while they're spending lesser, 44 bucks instead of 52. So the net cost is still negative, but much better. And more importantly, the discounts have gone down, 21 bucks going to 7 bucks, leading to a contribution of positive 23 bucks. Now, this is only 1 year statistics. What really needs to be seen whether the statistics can be sustained, but at least they've reached that contribution at a gross level, positive contribution. Now, the other aspect, which I just mentioned, is what is important is the customer lifetime value. Now, the customer lifetime value is basically a present value of the revenues minus the cost, right, from each customer. I tried looking at these data points in DRHP and Zomato. I actually could not find it. I could not find their retention rates. I could not find the lifetime value. I could not find any data point except one, which I'll present in the slide. But just from a theory perspective, I've just put in just a glimpse of how it is typically seen. So for the retention rate, we try and plot the annual retention rates of customers. From the annual retention rates, we are able to derive the lifetime retention rate. Now, in this example, I've assumed a 5-year life. These are the annual retentions of my existing customers. And if you aggregate them, the slope is obviously the downward curving. Now, the second part is to look at the lifetime revenue. We already had number of orders. We had gross order value. We have the commissions. What we just do is P into Q, number of orders into the commissions. We get the revenues from it. We adjust these revenues with this retention rate right on the left to get the lifetime revenue. This is how any business can figure out, if I have 100 customers, what is the kind of lifetime value I'm going to have from those customers. And finally, you got to plot it against the cost. And for the costing piece, you already have looked at unit economics example of Zomato. You have delivery cost, service cost, acquisition cost, etc. So if you do a comparison of the revenue and the cost, you'll then get finally the customer lifetime value, which can also be indicated as a ratio between revenue and cost. So in this example, for every $1 I spend, I'm expecting a $3 return. That is how one can plug it. Now, coming back to the Zomato's example, when I wanted to actually run this analysis, when I didn't get the data, the only data point which I found was the GOV retention by cohort. Basically, what they've done is they've given some statistics. If a customer, which I've acquired in year 1, is ordering worth 100 bucks, by the year 4, he's making an order of $300 in a year. Similarly, and this is a 4-year time frame. The one which I acquired 3 years back is doing 2.7 times. The one which I acquired 2 years back is doing 1.6 times. So it gives me, what is the input for average order value, but it does not give me how many customers are actually doing that. Because had this been all the customers doing that, the revenues of Zomato would have almost doubled or tripled in the last 2 years, right? Because the average order value has jumped, but that's not the case. In fact, the revenue declined, slightly, or not the revenues, the order value declined. Let me go back to the table. Where is that table? Yeah. So if you look at the monthly active users, they were 30 million in 9 months 2020, whereas they were 29, 19, and 42. So they have declined. The monthly transaction users were 6 million versus 11 million in 2020. So pretty much in line with 19. The number of orders is 155 million versus 191, but 403 in 2022. So clearly some of the statistics are more closer to 19 than 20. The only good statistics which I like about this table is average order value, which has gone back to 400, which they last saw in 18. So somewhere down the line, these are the few aspects one needs to take into account when you're looking at numbers. What is there? What is missing? What are the gaps? And then you analyze it. Moving on, the second pillar of the valuation matrix is market potential, because unit potential doesn't mean anything unless until you know at what scale are we talking about. This is purely at unit level. So what we do is we look at the overall market size, etc. From an India perspective, this is just a snapshot of parts of which was already there in Zomato DRHP. Parts of it I've picked up from some media articles. When you look at a food market, I think what comes to my mind is population. We are a population of 1.36 billion, many hungry people as well. And if you compare, in this example, it's US and China. We are as big as China, just slightly lesser, but multiple times the US. In fact, one shocking data point is that the number of internet users in India is already 2 times the population of the US. Well, isn't this a brilliant stats? Actually, I didn't realize it until I ran these numbers. And what it means for tech companies is it gives them such a large playground to play with versus the US. Obviously, what would really matter is how much of that percentage is really active. Because in India, if you see, only 9% of actually internet users are actually ordering. Whereas if you figure out US and China, these are actually going in 30s and 40s and 50%. So the consumer funnel is really low. And this is the chart which talks about the funnel. In India, we are talking about a 23% effective conversion of these internet users into online shoppers. Whereas if you look at China, that the conversion funnel is 70%. Now, a very specific data point with respect to the food market. If you look at the online food market, it's about 4.2 billion here. It's about 4.35 billion, I think, in 2020, which I've taken in the analysis, which is 1/5 of US, 21 billion in the US, and 1/20th or even 1/22nd, or rather, let me say, China is almost 20-25 times the India at 90 billion. And the percentage of food consumption from a restaurant perspective is very low. I mean, we just have 10% of population actually going out and eating out, whereas if you notice US and China, it's about 58%. Now, all these statistics, if you try and put together, what story do you get? I think one story which comes very clearly out that India has a great potential. Why? Our population is as big as China. Our access to internet to the people is not that bad. We are sitting at almost 500 million sort of a population with access to internet. However, a very small percentage of that is ordering. A very small percentage of the total population is actually eating out. So which means is if we try and combine these factors, of the size, of the segments, of the scale, we can actually look at a 5x growth in the next several years. And that's how, if you pick up the analyst reports, you're looking at 30, 40, 50% growth, even for Zomato in the next several years. In fact, one transaction which recently happened, which I've not covered here, but is BillDesk, which was acquired by PayU very recently, I think few weeks back. And I was looking at the statistics. The company got acquired and 15 times revenue. And the last transaction which took place in BuildX was about 2 years back, and the multiple at that time was 7x, 8x. So within a matter of just year and a half or 2 years, we have looked at a 2x sort of a growth in the revenue multiple. And the underlying company, the company has just grown by 25%. So clearly, I think people are betting on, the digital story, the India story, which is there. Now, continuing with the Zomato example, if we were to look into the Zomato's market potential, given all these statistics, the first step will be to look at the TAM. TAM is nothing but the total addressable market. One is obviously the food delivery market, but understand they've entered into other segments, including B2B, hyper pure, and grocery. Grocery, while the time I was doing this presentation, I got the news they've exited it because they want to continue focusing on grocers. So the TAM, which is the total size of the market, will keep changing. What is the really customer segment you are targeting? And also we understand that Zomato is in 24 countries, and India is just one of the market, but India is the primary market with 90% share. Now, the idea is really not to get to what is Zomato's TAM here, but the idea is really to give you a feel of what is should be the construct when you think about TAM. What are the things you need to take care into account? And as I said, these are some of the statistics which I presented again, which were again discussed in the previous slide. But it you should also try and benchmark these statistics, because here, let's say in this case, we are talking about Zomato is operating in 24 countries. So today, if you were to run an analysis, will you run on India or will you run on global? Right. And if you were to run on global, will you take same assumptions or different assumptions? So those are the questions you need to play with. The second important parameter is what is the market share. Now in India, we have Zomato and Swiggy leading the market shares. Almost both of them are close to 45, 50%. Now, if you look at the US market, DoorDash actually in the last few years have become a market leader with 57%. Uber Eats is coming down. In fact, in India, Uber Eats has already sold its or merged its operations with Zomato. If you look at China, Meituan has again emerged as a market leader. Earlier, LA.me was the market leader, and it's 65%. So there is a trend that we are getting one dominant players in some of these developed countries. But if you go to UK and Europe, that's not the case. You have multiple players having multiple shares. So Just Eat Takeaway is the market leader, but then you also have Delivery Hero, you have Deliveroo, and other guys having 20, 25% market share. So one needs to analyze how these trends are emerging. What is the kind of competition? Who's backing the competition? What is the kind of funding? Because you're burning a lot of funds. What is the kind of funding you have? What are the entry barriers you have created for them? Now, for Zomato, I think after listing, one entry barrier, which I think is access to cheaper cost of capital for them, because they are sitting on a $15 billion value. Now, if you look at Swiggy, their competitor, it's almost one third, or maybe it's increased because I heard SoftBank is putting more money in Swiggy after maybe looking at Zomato's return. But if you notice, so every dollar Zomato will burn, they're going to dilute 50% lesser than how Swiggy would dilute. And that's how some of these tech valuations are going, right? The market leader continues to win. However, from the downside perspective, we should also look at certain other factors, especially the new market entrants. For example, Ola is still there. Their fortunes may get revived with COVID improving and their electric vehicle becoming successful. Amazon has also started a soft launch in Bangalore, but Amazon is not there globally, so I don't know how serious their interest is. Then there is a risk of competitors banding together. There is the competitors are being supported by large names, SoftBank, Google, and I think one important parameter is also the take rates. So right now Zomato is getting 20-22% take rates as commissions from the restaurants, but tomorrow that might change. For example, global players are operating in a range 15 to 30%. Meituan is already below 2018. And then there are SaaS platforms like DotPay and Thrive emerging, which can again challenge the whole commission model and actually start making money through other services rather than taking direct commissions. So all those factors one needs to take into account when you are actually taking a call on market shares and revenue sharing. And also some of the questions listed here are very, very Zomato specific, but in the interest of time, maybe I'll just continue and finish this example. The third and the most important parameter is operating margins. Now we looked at, if you recall from unit economics, we look at the contribution per order. It's become positive at 23 bucks. But one thing which they have not adjusted in contribution per order metrics is their advertisement and sales promotion expenses, and we don't know have the breakup how much is targeted at a user versus a normal corporate branding. But if we were to just pick up the total amount from the balance sheet, from the P&L, and divide it by users, it's actually 22 rupees per order. So as soon as you adjust that, your contribution actually becomes almost zero. So these are the things one needs to take into account. At the same time, they're burning almost 18 bucks per order on delivery cost. If you notice, the actual cost was much higher than the recovered cost. We're talking about drone delivery, automatic vehicle, etc., etc. Now, tomorrow, such a technology comes, suddenly your 18 bucks get into a maybe even a positive zone. So that's how these things could be very dynamic. And finally, the labor laws. I think that's very important for some of these companies, because the labor laws can actually multiply the what do you say, the cost, because the employee benefits would have to be provided. So if you were to plot operating margins, what I did was I picked up analyst estimates from S&P Capital IQ, and looked at how these margins are expected from the analyst perspective. Actually, Zomato, we are looking at 5 years losses. DoorDash actually is becoming profitable next year, but the scale is very different. Do remember that. And Meishuan is already profitable and gonna become more profitable in the coming years. So what are the key questions here? The key questions are, will we continue our take rates? Is our current economics, unit economics sustainable? And what is the kind of long-term margins? Now, if you from a valuation perspective, while you have done this, if you put these numbers, if you put all these assumptions into certain numbers, because we want to run some heavy numbers, right, and come up with some cash flows. So I picked up these 3 or 4 important parameters and plugged it in: the market sizes, which we have looked at, the market share and the growth, which we have talked about, the market shares, which we have just talked about, and what is the gross order value, the take rates, giving the revenue for Zomato. Coming down to operating margins, this is a key variable, and I'll show you how key this variable is. And finally, looking at typical items and getting to the free cash flows. Now, from the operating margins perspective, for the assumption for this example, I picked up Meishuan's example and put 20% in the longer run. But if you were to move 15 to 25% as operating margins, the impact is almost 20 bucks per share. Right now, this is not the share value. This is just a contribution of India food delivery market. Remember, Zomato has many other segments. But if we were to actually play around the margins, suddenly your even in a 5% change, we are looking at a 20 bucks impact. Second important variable is the discounting variable. Why? Because right now I've picked up 15% return, but obviously it's a much more riskier sort of a stock. It could have required returns of higher 18%. Or if you're sitting in US, Europe, where you're in the era of free money, maybe the return requirements will be 12%. So again, almost like a 20, 25 buck difference here. So these are some of the aspects one need to take into account, but this will give you some sense of how to create a construct. Now, all this construct is not finished unless and until we also do a relative analysis, right? Which is the third parameter. Relative analysis, nothing. We pick up comparable companies, we pick up multiples, we adjust them, we apply weightages. But the two most important parts where we could make mistakes, and we mostly do, we learn over time, is to select the right comparables, A, and B, adjust these multiples. Now, now from a comparability perspective, there are various factors one needs to look at: business lines, market serves, nature of competition, etc., etc. I'm sure all of us are aware. But let's look at from an example perspective, how does it work? Now, when we look at Zomato, I picked up 2 global comps as their competitors, DoorDash and Meishuan. Sorry, I've jumped into my next slide, which I should not have. Now, from DoorDash and Meishuan perspective, what I did was I plotted some of the basic stats on market size, TAM, market shares coming from market potential. I plotted their recent EVs, right? 15 billion, 70 billion for DoorDash, 178 billion for Meishuan, and looked at how their EVs are actually talking to the market size. So for Zomato, it's India. I divided this by the current market size is actually 3x. I looked at DoorDash, it's actually 2.6. Meishuan, 3.5x. When I looked at these stats, I said, okay, this, it appears to be in some range, though I would tend to think, why should companies trade more than the market size? But maybe there are growth elements. So let's look at how does it fare really on the below statistic? Let's go to the revenue level. Now, revenue level, when I plotted, I got a strange multiple of 40 times for Zomato, say 17 and 7, which looked more reasonable, as to so to say, for DoorDash and Meesho. Then I adjusted for growth. If you remember our IPO study, there was a lot of growth happening. For Zomato, the expected growth is 40% over the next 5 years, 28 and 29 for these two. When you do a growth adjusted revenue multiple, I was getting 1x for Zomato, zero point 0.6 for DoorDash and Meesho. This should be seen relatively, not as a standalone EV by revenue multiple. This is more like a relative multiple. And finally, I think this won't be complete if we look at the margins. Now, for the margins, the biggest problem was that we did not have a long-term expected margins for Zomato. So I really did not ended up doing those multiples, but we can do that. And I have a case study around it. But before I jump into another case study, the point I was just trying to make here is, now, typically you've looked at the business model, you've looked at unit economics, you've looked at the market potential, the sizes, the shares, and also possibly got a feel of margins. Finally, you also need to benchmark those statistics with the market, with the larger market, especially when you're looking at larger tech players in the industry, and then get a feel of, yes, how is this relative valuation working? Is it higher, lower? Is it making sense? And if it is higher, are there reasons to support it? And that's what I've tried doing it, though in this example, it's a little incomplete because I did not have revenues beyond 5 years. I did not have a long-term margins, so I left it there. And with this, I want to pick up one case example. If you remember Circle, this was the top two, SPACs which were there. One was Aurora, followed by Circle. Now, Circle, I know there's a lot of stuff, and I'm trying to catch on to it, but don't worry about the numbers. Just worry about the concepts here. Circle is into internet payment, etc. System. It has a cryptocurrency platform. It's offering digital payments. So there are multiple segments here. And if we were to plot comparables for such a company, there's no perfect comparable, unlike Zomato, where we really got a close comparable. So the management, this has come from their investor presentation. Management actually picked up comparables from three segments, where it was payment networks, which is Visa and MasterCard. Second is the high growth payments, which are faster growing digital payment companies like Adyen, Square, etc. And finally, the digital asset companies, cryptocurrency companies, Coinbase, Buck, and Silvergate, like that. Now, if we were to plot, let's assume these comps are right. Let's not question them. But if we were to plot certain numbers, these are the numbers which we got. And just just forget the too much data which is there, but just follow the numbers. Circle is sitting at a $4.5 billion of numbers, while some of the comps are actually sitting at 100, 200, 300 billion dollars. However, there are a couple of comps which are smaller comps like Circle as well. Average and the median EVs is 100 to 150 billion dollars. So clearly much smaller in size. But what's important is to also look at what is the revenue multiple. Now, Circle's revenue multiple is about 39 times EV by revenue based on the LTM revenues. Whereas if you look at for the comps in a wide range, 20x, 80x, 50x, 30x, even 10x, the average and median is pretty close to Circle, 34 and 38, right? Somewhat making sense, but let's look at growth. Circle's expected growth over the next few years is 180% because it's a small company, it's just started, whereas some of the other comps was sitting at 40, 50%. Average and median is 30 and 50%. And if we were to do a growth adjusted multiple, the way we have done earlier, Circle's multiple actually comes down to 0.2x. Some of the other pairs are over 1x, 1.2x. Average and median is 1.2 and 1.5x. So on a relative basis, it does appear that Circle is fairly attractive from that perspective. So, however, we also need to look at EBITDA margins because we've looked at the revenue, we've looked at EV, then we looked at the revenue growth. Now the second comes the EBITDA margins. Now, if you notice, in EBITDA margins, the Circles isn't expected to be profitable as much as the pairs. It's expected to earn 10%. This has come from the investor presentation in the next 3 years. Whereas the pairs are actually sitting at 60% margins, 70% margins, 30% margin. So average and median is about 30%. So from that perspective, definitely there should be a discount to revenue multiple of Circle. If you adjust for both the growth and the margins, what happens is the multiples now start talking to the Circle's multiple. So if you recall in the previous slide, we were getting 0.2, but 1x, 1.2, 1.3x, which was just the growth adjusted. But if you adjust the margins, now these Circles multiple is actually pretty much in line with most of them except Coinbase, which is a digital asset cryptocurrency player. Another thing is, if you recall the first slide, Circle was very, very small. Circle was amongst the smallest. Now, typically, if an investor wants to invest in such a small company, they would want slightly higher alpha from it. So what I've also done is I've now built in 10% alpha in the same multiples to look at how would the Circle's multiple be. Now, the same set of multiples, when we look at on the relative basis, this is a relative upside ratio I define. Relative upside ratio is nothing but the multiples which we got on growth and margin adjusted, we divided by the Circle's multiple to get a relative multiple. So if you have a relative multiple of 1, it means that yes, it makes sense because you can grow faster than that comp. However, if it is below 1, then maybe you can't. Maybe that it doesn't make sense to invest in Circle. Now, suddenly, if you do that adjustment for relative upside ratio, sorry, for the 10% alpha, what happens? These multiples actually become closer to 1, because being a small company, much lesser growth, more risk, and becoming profitable in 3 years, you need alpha. The multiples actually start making sense. So this is just a construct of how one can go about doing a step-to-step relative analysis. Going to the details, obviously you need a lot of data to do that, but this is one of the techniques which I found could be quite useful in understanding how this can be done. I will not get into this. The second example, this was if the margins were to change from 10 to 35%, what happens? Obviously the multiples jump up, because I'm very of time and I just have one very quick last section to cover, which is on IPO disclosure and storytelling. This is, let me take few minutes, finish it, and Srinivas, maybe then we can come to queries. Um, Nothing unusual. Everyone knows there are important documents like DRHP or S1 filed when you go for an IPO in India and the US respectively. There are these important sections which one needs to take care of. You have business descriptions, which talks about the business model. It also sometimes talks about the organic and inorganic growth strategies. Then we have industry section, which talks about certain comparisons and market share. We have risk factors, external, internal. Sometimes some of the risks which are very important to look at is the company specific risk, because they may reveal what's going to happen, especially even if there's no direct forecast, there is indirectly um, some sort of language given on what they're expecting in terms of changing margins. Another important section is on management, the board of directors, their backgrounds, their profiling, what they've achieved in the past. I think we can do all that research. The utilization of proceeds is another one, which is important. Where the money is going, how um, closely they're defining their needs. Is it going to repay the debt, working capital, or expansion, or is this purely loss funding? 9 out of 10 times, I think you'll find loss funding for new age companies. And finally, you also have a section called MDA, Management Discussion Analysis. I actually like this section. In fact, even today, when I have to do a valuation, I have some listed companies which are a little new. I'll go to their MDA section, look at their business model, look at the drivers, what they're trying to say. Now, what is interesting is while this IPO and SPAC rush is happening, there is a lot of extra information being given to the investors and analysts, and we are seeing that this information has a very strong storyline. It talks about the app users, it talks about the downloads, their addressable market, the unit economics, but sometimes very critical aspects are missing. So, including what is the acquisition cost of the user, what are the attrition rates and the renewal rates, what is the cohort attrition adjusted returns. And then over and above, some of the companies have actually started giving 7-year, 8 years, 10 years projections. I've seen investor presentations, especially in all these SPAC scenarios, that the target companies are giving financial projection running into the next 10 years. And they may not be actually making money right now, but they are showing what revenue and EBITDA they'll have after 10 years. Now, what it is doing is it's actually led blindly running certain analysis, certain relative analysis, which I just showed. Sometimes even that's also a part of the presentations. And without applying any analysis and judgment, we are actually picking up and believing in those stories. So the key question is, is the projected story plausible? Is the storyline which is giving is talking to the numbers, and the only way to do is fill the gaps. Fill the whole story, build the unit economics, build the market potential, and run the relative analysis, and then see, oh, is it making sense or not? And one example, quick one, which I just wanted to show, I really don't want to get into analysis, is Aurora Innovation. It's the same company which we picked up earlier. If you notice, this is just a snapshot of the projections they have given for the next several years, 6 years here. The company is not expected to make any revenue for the next 4 years. Its margin is turning positive in the 7th year, which is 2027. And it is expecting to burn about $4 billion in 7 years. And this is all given in the presentation. The other thing they have given in the presentation is what their peers are and how they benchmark. If you look at the first one is on revenue growth, it's really the tallest bar except Quantum Scape, I think, and Too Simple. The second one is the gross margin, again, doing very well, right? 67%, right? And it does appear it's a good valuation story. However, do notice that the years are very different. For Aurora, they're talking about 2025 and 2027, but trying to compare with 2021 and 2023. And that's true even for gross margins. Some of the comparables they have taken are all over the place. There is one cloud-based data platform company, Snowflake. There's one e-commerce platform, Shopify. There's again another cloud-based communication platform, Twilio. There's Tesla, electric vehicles. Maybe closer to what they're trying to do is autonomous software company. The last four are still making sense. Autonomy solutions, autonomous technology, designing EV technology, etc. And the valuation benchmarking, again, coming from the presentation, by the way, similarly, where they've benchmarked themselves with EV by revenue and EV by gross profit, again, seems to be the lowest sort of valued stock in this entire comparable, right? But again, if you notice, the years are very different. And the second one is a gross profit, not an EBITDA multiple. Now, what we did, we picked up all this and I put all these data points, assuming these comps are right, assuming what their story is right. I just put it in my relative analysis model, which I did for Circle, which I've taken you all through. This was the outcome. The adjusted multiples and the relative upside ratio is as follows. Aurora's growth and margin adjusted EV by revenue is 1.6x. Snowflake's is the only one which has beaten Aurora. And there is a reason, because we couldn't find Snowflake's margins beyond 2023. So it's at 5%, whereas for all comms, we got margins till 2025. And if you notice, Aurora's multiple is the highest. And if you were to run the same analysis and do a relative comparison of these multiples, it's actually the median and the average is 0.5. So with this, I would just like to, just rephrase that question: is the projected valuation story still plausible? And with this, I think, Srinivas, I can hand it over to you for Q&A.
Yeah,
Sorry
no,
for
there's
the bullet train run, which I had to do because of time.
this is good. See, I guess you can only cover so much, and you've kind of given a very good tool set or toolkit, to use the phrase toolkit, for people to get handles on what they could do things. There's lots of questions. Let me pick them up in the order that I saw, and I'm sorry if I have missed any questions. So Jim Sheff, and if you can limit the answers to 30 seconds or so, right? Jim Sheffield is asking about the history of SPACs, revaluing the D-SPAC valuation post a market move down. Is there any history of SPACs, where any resource that people can go to?
So there is a website which is also quoted in my decks called SPAC Insider. It has details of all the SPACs, and it talks about industry wise, geography wise, etc., etc. So I think maybe that's a good resource to go through. Obviously, all SPAC details are public. These are filed, all documents are filed with SEC. Some of these are adequately captured in media articles as well and databases as well. But yes, SPAC Insider could be a good resource.
Right.
Next
So
one.
going back to this Shardul and Sankalp's questions, right, on how do you take a single factor? I mean, what you have done really is impeccable, Aviral, because you've given several different angles to view at the same company, right? We looked at the market, then we looked at the valuation multiples. We tried to look at you try to take the market return itself, and so on and so forth. But how do you take a specific factor such as the geopolitical risk or the uncertainty? Will that reflect in the discount rate? Is that what is done traditionally?
So there are two, three ways, Srinivas, of factoring geopolitical risk. Part of the risk is getting already factored in the discount rate. If we were to start with a base discount rate, let's say from the US, there's something called country risk premiums, and these country risk premiums actually factor in geopolitical risk. The other part is you can also look at how currency is appreciating or depreciating against the dollar. Then that will also give you the feel of how the geopolitical risk is also getting priced in the local currency as well. How we try and do is we try and build two things. One is obviously the discount rate. I think large part of geopolitical risk gets factored there. However, in the scenarios like the Great Chinese Crackdown, I think where you are having a big regulatory change, very difficult to price that in the discount rate.
Yeah.
So somewhere down the line, you got to come up with a certain probability, not of default, but of that regulatory change impacting your business, which is going to lead to definitely a shorter TAM, maybe a smaller TAM or a slower growing TAM, lower market share. Maybe you have to break up as well, and eventually lower margins. So there has to be a scenario which has to be built in with that if the regulatory change is becoming really plausible at that time. And we have done that scenario analysis in some of the cases, especially in COVID. If you recall, the stock market tanked. That was the initial reaction. Every stock was almost down by 50, 60%. So we ran scenarios of recovery, COVID recovery scenarios at that time. It's akin to that.
Right, right. The other question, Monica has this question, and I won't probably guess the name of the person. So she's saying that one very noted valuation expert has got a very low price for Zomato, but the actual price is 133, and probably the answer is you already gave the answer, but can you comment on this?
Sorry. So
For
pre-listing
Zomato.
somebody got at low price, and post-listing the price is high. Is that the question?
Yeah, that's right. So I'm not very sure. I'm not very sure whether this expert valued this at pre-listing stage, but there's a large difference between the current price and value. The global valuation expert got this price.
Acha, okay. Sorry. So again, it's all driven by assumptions. So I actually in my slide mentioned three of the big assumptions: the TAM, the market share, etc. Number one. Number two, there is, the markets today. If you notice from the IPO study also, which I presented, possibly there is a clear signal of an overrun somewhere, right? There is high liquidity, low interest rates. There's also something called FOMO. I don't know if you've heard of that,
Yeah,
fear of missing out. And
yeah,
in India, Srinivas, if you see, if there is so much of hot capital chasing new age businesses, how many such companies do we have listed today? Perhaps two or three. I mean, when you try and figure out an Indian comp for Zomato, you won't find more than two or three companies, right? Maybe the
right.
closest one, you have India Mart, or you have InfoEdge, its parent itself, which is again kind of a replica, or you have Just Dial, right? These are the ones. So, but if you go to US and China, almost 20 to 25% of their index is built of these digital businesses companies. In India, we are just starting. So there is so much capital chasing these companies that clearly it's somewhere down the line beyond fundamentals, and that's what happened in that example.
Right. So one question, related question from Sagar is on for angel investors. How should, I mean, for at least for the IPO stage, you get a lot of data, but companies just starting off. So how do you, as a valuation expert, what is your advice, Aviral?
So for angel investors, there are different ways. He's absolutely right that we would not have access to data like what I'd use for IPO companies. But for angel investors, again, the basic and the fundamentals still remain the same. The only thing is the drivers are different. So you start with the management first, you start with the business plan, you start with the viability of product, then eventually you look at the what is the market size, what is the solution you're offering, and what is the market size of that, and then take a punt, because at that stage you're not able to bring in a lot of shares, market shares and margins, etc. So you start maybe at the TAM level and at the management level and the solution level. And as the companies progress, they become more mature. You start adding more variables to the valuation model. That's how it happens.
Yeah. So one of the listeners, they have asked a question on alpha. You've taken. Let me quote so as to not miss this. It is interesting that we are using alpha as a measure of risk compensation. Our traditional understanding was to use beta as risk compensation, while alpha is excess returns. So can you elaborate quickly, because there's other questions also.
Right. So alpha is basically used for very company specific risk factors. One component, major component, which we price as valuation practitioners is the size, which is also reflective of risk. It's typically well known that larger companies will have lower risk versus the smaller size. And there are studies to believe that there is a specific size premium, which is always allocated to smaller sized companies. These studies are available in public domain. In fact, our own firm publishes it. Sorry for marketing my own firm, but we are actually publishing a lot of these cost of capital yearbooks and studies. But coming back to the question, size is one. Second thing is, what are you applying discount rate at? You're applying discount rates on projected cash flows. Now, one set of projected cash flows is very different from the other, not just because of the underlying fundamentals, but because of the level of optimism and aggression which is there in the financial projections. Now, if the aggression is really beyond par, above average, if I may use that term, you'll have to build in certain alpha, right? If you were to bring it apples to apples vis-a-vis comparables. So the financial projections, the risk in financial projections, which is beyond the typical risk and driven by the assumptions, also make us take a slightly higher alpha than the others. Now, in the example which I took, Srinivas Circle, I just took a 10% alpha, just as an alpha which should be there for us, given the relative size of the company, given the fact that it's still trying to become profitable, much smaller in size, trying to become profitable, and the value is driven purely by the projected growth. So those are the aspects which I thought to run an analysis for 10% alpha.
Right. One last question. I am aware that it's seven o'clock now. So just one last question. Sorry, Aviral. On edutech, because edutech is very big and it's a very crowded field. So Ramchandran Iyer is asking, how does the unit economics versus market view work for edutech? Very quick insight, if that's okay.
I think it's going to be similar at the end of the day. EduTech is also, so one is the COVID impact. A lot of these traditional institutions are becoming tech focused, etc. The second is the EduTech's own journey, where people are looking for learning online, and there is a big change in the user behavior now. The acceptance and the level of the magnitude of acceptance has completely changed post-COVID. So at the end of the day, the parameters are still the same. You look at the total education market, you look at the market which is currently driven by online. I'm not talking about traditional using online, but really by courses which are really being delivered online and which will continue to be delivered online. And then you also build in a parameter where the globals are standing, where is US and China standing, where can India reach? And finally come down to users, how many users you have, what is the kind of contribution margins. Again, look at unit economics there, acquisition costs, service costs, etc. And coming down to the fact that what is the long-term scale and margins you need to operate. So I can just convert this whole Zomato's example into any edutech, let's say Byju's, etc. And just take the right variables. The second thing which has happened in edutech is that there are a lot of acquisitions which are taking place. Bigger guy acquiring smaller fish. Now, a part of that story is, and it's part of the valuation story, that you might get valued at 20x, 30x revenue, but you are acquiring targets of 5x revenue, 10x revenue. That's another alpha which is getting created. Alpha in terms of returns, not in terms of risk, which is getting created in this story and which is very prevalent for edutech. I mean, you look at Byju's, it's possibly done 10 acquisitions, maybe doing another one as we are talking. So we'll have to wait and watch and see how many players emerge at the end. What is the kind of competition we'll have? And then we can run these stats and get an answer.
So, Aviral, thank you so much. Any quick career advice for our folks, charter holder members? There's it seems that there's a torrent of money coming in. In addition to investing, what is the career advice for them?
I think it's brilliant times for them. Year back, if I were doing this session, maybe I would be in a slightly gloomy mood because of COVID, and we were very uncertain what's going to happen. But now these are the best times. The traditional models have changed. We are moving towards tech-driven, digital consumption, new age businesses. So with this, what's happening? There is so much potential because there are hundreds of companies waiting to become unicorns. Srinivas, you mentioned, I think on one of the messages, 2 unicorns a month. That's the average we are getting to. And there is another term called Sunicons. We have Sunicons waiting to become unicorns. That list is also getting tracked. So, with all this action happening, I think our charter holders should focus on roles around corporate finance, valuations, equity research, business consulting, strategy consulting. I think all these services will be required by the industry and are being required by the industry. At the other end, somebody getting into accounting, that's going to do well. Somebody getting into fund management. I think the VC and PE funds will be are already back to the hiring streets. They're hiring as many people because suddenly their benchmarking has changed. So we have Zomato listed. Zomato listed will give 10 other VCs who have invested in Swiggy and Dunzo benchmarks to value them and tell their LPC, this is the kind of return I'm making. So that is a kind of story now we have for India, where we have a success story right in front of us listed in Indian market. And that's the real sort of the proof of the pudding. So VCPs, so let me come down. So consulting, you have advisory, financial advisory and consulting. You have PVCs, and then you have banking and accounting. So all these services, wonderful careers ahead, and I wish them all the best.
Thank you so much. Thank you so much all for listening. Thank you very, very much, Aviral. Really appreciate your time and the way you taught it. It's just amazing. I just wanted to remind folks that on 7th of October, we've got Saurabh Mishra, a past board of director. He will be talking on careers in structured finance. And 21st of October, we'll have another veteran, Harshad Patwardhan, who just got the best fund manager award in the mid-cap space. So those webinars are lined up. Thank you once again. Thank you very much. Stay safe. Thanks a lot, Aviral.
Thank you.
That's all for
Thanks,
today.
everyone.